I have with me Howard Davies, the director of the LSC. Howard Davies, thank you very much for joining us. Let me start by asking you what you collect in terms of opinion from across the varied guests that you've been interacting with here in Davos.
Well, I think the two-speed economy is pretty evident.
Right.
The Chinese and the Indians are pretty upbeat. Their problems are potentially overheating, a bit of inflationary risk, but generally they're positive. Whereas the US, I think, is still quite nervous. Figures coming out of the US on the housing market and on debt foreclosures are still pretty pessimistic. And the UK, of course, slipped back in the last quarter. Whereas the eurozone, well, it's mixed. Germany's doing fine, the southern Europeans not so. So on average, the eurozone isn't very exciting either. So this two-speed economy between East and West, if you like, was, I think, what we came in expecting to find, and I think that's what we found.
Howard, the last year, most of the conversation was dominated by the sovereign crisis that the eurozone seemed to be facing. This year, the conversations seem a lot more local to me. The Americans are talking about joblessness, Europe is talking about the relevance of the euro, and the emerging markets are on a different trip altogether, if I can use that slang. What do you make of what impact this will have on coordinated global economic strategy, if at all, or are we now all breaking into pieces and dealing with local problems?
I think that's an interesting observation. The way it looks to me is this, that when the recession hit, we all went in together. We went in different ways. Of course, it wasn't an actual real recession in China and India, but nonetheless, growth slipped back and everybody was worried. And then, in the middle of the crisis, there was undoubtedly a feeling that we were all in this together and we all had to do our bit. Then coming out, people have come out in very different ways. And I think the reason is because if you went into the crisis with a lot of debt, an unstable fiscal position, then you are really struggling on the way out because you're facing both getting the economy going again, but paying off debt at the same time, which is tough. So undoubtedly now there isn't the same commonality of interest in looking at the world economy as there was before, and as a result, I think the G20 is going to be quite difficult this year, and I think Sarkozy's ambitions that he set out today for reforming the international financial system, I think that's going to be quite hard because I think people don't feel the same commonality of view now.
So that means all the IMF reform, the World Bank reform that we were talking about 2 years ago, all of that goes on to the back burner, doesn't it?
Yes, I mean, Sarkozy set out an interesting agenda today, and of course, since he's in the chair at the moment, then the French we have to listen to as to what they want to put on the agenda. Yeah. So, and he clearly says today, he said, well, we may not be able to reform the whole international financial system, but we can set in place some of the foundation stones. So I took that a little bit as a recognition that probably he wasn't going to get as far as he had once hoped.
Give me a sense of what you make of the eurozone right now.
Yes, well, up to now, I'm afraid that the eurozone has dealt with its crises on an ad hoc basis. A crisis has come along and they've met all over a weekend and produced something for Greece or for Ireland to try to stem the bleeding. There's a realization, I think, now that won't work in the long run, and that the eurozone cannot stumble from crisis weekend to crisis weekend. They need to put in place structures which will allow the eurozone to survive in the long run.
Do you think that the UK is headed for a double dip, or were the fourth quarter numbers related to the weather mostly?
Well, the weather was a factor, I think, in the construction sector, because when there's a lot of snow, people don't build things outside. But it's very hard to explain why financial services contracted just because of the weather. On the whole, it doesn't snow inside banks. So I don't think you can blame it all on the weather. Also, however, you can't really blame it all on the government's austerity plans, because in fact the main impact of those will be felt from this year onwards. The VAT rate went up on the 1st of January, which is of course after the quarter, and also the big spending cuts in the public sector will take place in the next financial year. So I'm afraid what we're seeing in the UK is that we still have a nervous recovery. It's consumers who don't really feel confident enough to go back to the same spending patterns as before. People, if they've got a bit of money to spare, they're inclined to pay off debt because they worry that they had too much debt, their mortgages are worth more than the value of their house. So I still think, the key thing is confidence. As to whether there's a double dip, personally I wouldn't bet on it.
Okay.
I couldn't give you a very good rational argument as to why it won't happen, but I don't sense in the UK a feeling of panic. I sense a feeling that this healing process is taking quite a long time because we do need to get our public debt and our private debt levels down to a sustainable number.
Okay. In terms of central bank action, I'm curious to know what you make of the Fed's continued policy of obviously to keep rates at where they are, which we just heard from 2 days ago. They did make a mention of commodity inflation. The ECB continues with its loose monetary policy, if I can term it that. Is that going to be the stance through the course of 2011, or do you think towards the latter half of the year you might see these central banks review their position, especially with the inflation issue hanging above them?
Yes, I think in the UK we might see a rate increase by the end of the year. The balance of opinion on the Monetary Policy Committee is shifting a little bit in the light of the inflation performance, which is bad. I'd be surprised in the US if unemployment remains at its current level, if we would see an interest rate increase, certainly not in the first half of the year, and I doubt in the latter half of the year. I think the first thing that they will do if they feel more confident is to reverse quantitative easing before they get round to an interest rate rise. Now in the eurozone, whoa, there's going to be a tricky one, because you could argue now for an increase in interest rates in Germany, given the rapidity of the German recovery, but of course this would be bad news in Ireland and Greece and Portugal and Spain. I think on balance the ECB will hold off as long as it can.
So how big a concern do you think inflation will be for the rest of the world, because it is currently a very big concern for the emerging markets? So through the course of 2011 and maybe even 2012, will inflation come back to haunt us?
Well, most of the emerging market banks have begun tightening policy already, of course. We don't know if that'll be enough. In China, which I know better than many other emerging markets, I've got quite a lot of confidence in the authorities' ability to control this. They have a flexible range of policies in China, not just interest rate changes. They have kept some controls over loan-to-deposit rates in the housing market, over income multiples for lending, reserve requirements at the central bank, and they've got quite a lot of dials they can turn in order to take the steam out of property price inflation and inflation generally. And you have to say, over the last decade or so, the Chinese authorities have proved themselves to be very skillful.
We spent the last 3 years debating what needs to be done to plug the gaps that led us to the 2007 crisis. What do you make of all the changes that have happened, whether it's the Frank-Dodd bill in the US or several of the changes that are going on in the UK, including doing away with the FSA maybe in the next 2 years? Do you think that we've been effectively putting in place a regulatory architecture that can help sort of, keep the next crisis away, if at all?
Well, I think the answer varies from place to place. Personally, I think the work that the Basel Committee has done has been good and positive. There are elements of it you can argue with, but I think that they have created a new capital regime, which looks to me to be a sound basis for the future. Dodd-Frank in the States, well, it's 2,300 pages long. It was passed a couple of months ago, and now somebody's starting to read it. And we really don't know yet what it means, because it involves a huge amount of rulemaking, and there's a lot of mischief could be done there. So I think the US scene is still very volatile. As for the structure of regulation in the UK, well, I was the first chairman of the FSA, and so I'm not likely to welcome it being dismantled. I think it's a distraction for us. I don't think it's helping. I think most of the banks believe that it's unfortunate that it's happening at the moment, because it's one more thing they've got to deal with, and they're losing a lot of good, competent staff who are thinking, well, they'd rather go outside than take their chances in the new organisation. So I don't think this is a good idea. But, the government's there, it's got a majority, it's going to do it, so they'll have to live with it.
But effectively, do all of these add up to strong, good measures to help prevent the next crisis at all?
I think the key is capital. I think honestly that regulatory structure, whether you have one FSA or 17 FSAs, actually, if you look at what's happened around the world, it's very difficult to say that one particular regulatory structure worked better than another.
Right.
So the capital regime is the most important thing, and I think we do have a better capital regime in place. I think you'd be a madman to say that this will definitely prevent future crises, because we don't know what's around the corner. But I think quite a lot of good work has been done to establish a sounder capital basis for the future.